On a quiet afternoon, with no cameras rolling and no headlines blinking, a single court filing changed everything. The U.S. Department of Justice announced on May 29, 2026, that it intended to appeal a federal ruling that had ordered the return of $166 billion in tariff payments to American importers. That detail tells you that the structural relief hundreds of thousands of companies had integrated into their multi-year fiscal planning is now completely frozen. To understand why this legal maneuver is so explosive, one must look at the timeline that built this crisis. In April 2025, the administration utilized the International Emergency Economic Powers Act of 1977 to implement broad reciprocal tariffs on global imports, triggering immediate legal challenges from over 2,000 domestic corporations. The legal battle culminated on February 20, 2026, when the Supreme Court ruled 6-3 in Learning Resources, Inc. versus Trump that the executive branch lacks the constitutional authority to levy tariffs under that statute. That historic decision effectively ordered the government to return approximately $166 billion in collected duties, a sum that exceeds the combined annual budgets of the Department of Transportation and the Department of Justice for fiscal year 2025. That sequence of events is not coincidental. The immediate filing of the appeal by the Department of Justice reveals a deliberate policy statement by the executive branch to prevent capital from flowing back into the private sector. By locking up $166 billion in prolonged appellate litigation, the government is structurally suppressing the liquidity of major domestic retailers and manufacturers. Businesses that had already restructured corporate debt, altered warehouse procurement strategies, and reallocated revenue forecasts around the expected spring payouts are facing sudden operational instability. What that framework does structurally is force American supply chains to absorb the cost of a tariff that the highest court in the nation has already deemed unconstitutional. This financial gridlock occurs precisely as regional manufacturing hubs attempt to hedge against broader trade volatility. The enforcement of these capital restrictions leaves hundreds of thousands of companies unable to finance alternative supply routes or diversify away from vulnerable trade corridors. When capital is artificially detained by federal litigation, the target corporations must either reduce operating capacity or pass the financial strain down to the consumer level through elevated pricing structures. This means that the economic friction generated by the original April 10, 2025 tariffs remains fully active within the market, despite the Supreme Court ruling meant to dismantle it. The strategy behind the timing of the document is equally instructive. By entering the notice of appeal late on a Friday afternoon, without a corresponding White House press briefing or presidential address, the administration managed to delay immediate market reactions while solidifying its legal hold on the funds. That detail tells you that the executive branch prioritizes regulatory continuity over immediate legislative clarity, choosing to sustain trade pressure via the judiciary rather than waiting for congressional action. For the broader supply chain economy, this institutional choice guarantees that trade policy will remain highly unpredictable well into the next fiscal cycle. The implications of this freeze extend far beyond the balance sheets of domestic corporations. They signal a fundamental shift in how international trade law is enforced and resisted. When the executive branch demonstrates a willingness to utilize appellate delays to bypass judicial mandates, foreign trade partners must recalculate the stability of the entire American consumer market. That shift in risk assessment alters foreign direct investment flows. As multinational corporations look for more predictable environments, where court-ordered refunds are not vulnerable to sudden bureaucrat containment. But the more consequential question, the one that corporate logistics directors and international trade lawyers are watching with intense strategic scrutiny, was still unanswered. The sudden appellate freeze on $166 billion in corporate refunds exposes an intentional strategy by Washington to protect its sovereign capital reserves while maintaining aggressive leverage over global supply networks. This structural deadlock places domestic industries in direct jeopardy transforming an apparent judicial victory into a protracted battle of financial attrition. The focus now shifts from the baseline legality of executive actions to the underlying geopolitical mechanism that motivated this quiet intervention. On May 27, 2026, just 2 days prior to the Department of Justice filing, Canadian Energy Minister Tim Hodgson stood in Vancouver to announce a 20-year energy pact with Germany's state-backed utility, Securing Energy for Europe. Under this agreement, Germany will import 1 million tons of liquefied natural gas per annum from the proposed $26 billion Kassai-Lysims floating facility on the coast of British Columbia. That detail tells you that Ottawa is executing a highly calculated departure from the American trade sphere, deliberately utilizing its resource wealth to anchor its economic future directly to European industrial survival. Canada.ca eShow 1. What that response reveals is a deliberate choice not to close a door, but rather to construct an independent geopolitical bridge that bypasses Washington entirely. Minister Hodgson emphasized this long-term reorientation by stating, "We must build projects that strengthen our economy, that diversify our supply chains, and that enhance our energy sovereignty, as well as expand our exports beyond a single market." That statement confirms that the Canadian state is actively seeking immunity from future American economic policy swings by commercializing its geographic proximity to both Atlantic and Pacific buyers. By transforming natural gas that commands $3 to $4 per gigajoule in North America into an asset worth 4 times that amount in energy-starved European markets, Canada is rewriting its domestic revenue mathematics. Barriere Star Journal. The structural pivot is heavily backed by capital relocations detailed in the 2025 Canadian federal budget, which committed to doubling non-US exports to $600 billion Canadian dollars by the year 2035. To catalyze this transition, the state deployed an immediate $5 billion into targeted trade infrastructure, alongside a $4 billion direct subsidy package for Western Canadian energy projects. That sequence is not coincidental. It is a direct policy statement that Ottawa intends to transition from a passive continental resource supplier into an assertive, independent global energy superpower. By underwriting the North Coast transmission line to feed 600 megawatts of clean hydroelectricity to the Saxe-Lysims facility, the Canadian government is guaranteeing that its exports can clear the strict carbon border adjustment mechanisms currently being implemented across the European Union. Barriere Star Journal. This accelerating autonomy introduces profound strategic friction into the broader Western alliance structure, particularly as European states recalibrate their baseline dependencies. Germany currently relies on the United States for approximately 2/3 of its total liquefied natural gas intake, an exposure level that Berlin views as dangerously unsustainable in an era of unpredictable American executive mandates. The German government recently halved its 2026 domestic economic growth forecast to a mere 0.5%, directly citing the massive energy shocks generated by ongoing structural instability across the Middle East and Iran. Securing a multi-decade supply corridor with a democratic G7 partner like Canada operates as a vital macroeconomic insurance policy against future disruptions in the transatlantic relationship. Yet, as this alternative trade architecture solidifies, the immediate commercial viability of the infrastructure itself faces severe internal constraints. The estimated capital expenditure for the Kassai-Lysims installation has escalated by nearly 3 times its baseline projections, ballooning to $26 billion without having reached a formal final investment decision from its corporate sponsors. That variance matters enormously because the project is structurally reliant on Houston-based Western LNG, an asset vehicle backed by Blackstone Capital, meaning the underlying physical infrastructure could theoretically be redeployed to an alternate international jurisdiction if local development costs become prohibitive. This asymmetric risk profile forces Canadian taxpayers to carry the infrastructure burden for a commercial asset whose long-term alignment with Canadian sovereign interests remains entirely unhedged. Global news simultaneously the regulatory and social foundations of this energy corridor are fracturing along regional legal lines, as domestic opposition groups mount a coordinated counter-offensive against federal fast-tracking initiatives. The Lax Kw'alaams Band and the Metlakatla First Nation have initiated separate judicial reviews in federal court, while the Gidenyao Hereditary Chiefs have advanced a challenge to the Supreme Court of Canada targeting the 900-kilometer Prince Rupert gas transmission pipeline. These structural legal interventions possess the exact statutory capacity required to indefinitely delay construction schedules, threatening to leave the multi-billion-dollar North Coast transmission line without an active operational facility to power by the end of the decade. Barriere Star Journal. The immediate trajectory of this entire trans-Pacific trade pivot now hinges on a critical milestone scheduled for the upcoming months. Financial markets are watching to see whether the project partners can successfully translate the new German supply contracts into the massive private capital injections required to clear the final investment decision deadline by the end of the summer. The collision between rigid regulatory containment in Washington and active resource diplomacy in Ottawa exposes the fragmented nature of modern trade architecture. This division means that while individual corporate entities remain trapped in prolonged domestic legal battles, state actors are already moving to construct alternative economic systems that operate entirely outside traditional channels. The baseline friction established by the $166 billion tariff freeze serves as the domestic backdrop for a far more expansive international reorientation. For the United States, the strategic insistence on retaining control over billions in contested trade revenue signals a distinct transition toward defensive economic isolation. By prioritizing short-term capital preservation over institutional predictability, Washington is inadvertently forcing its closest trading partners to treat the American market as an unstable environment. This creates a direct structural opening for middle powers to capture market share by offering the exact policy continuity that the executive branch has temporarily suspended. For Canada and its European partners, the successful execution of independent energy agreements represents a profound shift in regional power dynamics. By establishing direct commercial lifelines that bypass continental intermediates, Ottawa is effectively transforming its vast natural resource base into a tool of strategic autonomy. This model provides nations like Germany with a vital mechanism to reduce their systemic exposure to single-source dependencies, shifting the broader gravity of global energy trade toward predictable, treaty-backed relationships. Ultimately, this entire sequence of events demonstrates that the traditional rules of international commerce are no longer governed by centralized economic consensus. That pattern tells you that when the largest consumer market in the world leverages its judicial system to delay massive financial restitution, the rest of the global economy will not simply wait for a resolution. Instead, capital and resources will naturally seek out alternative corridors where strategic alignment is solidified by binding long-term contracts rather than volatile political mandates. The true bottom line is that while domestic courts continue to debate the limits of executive power, the physical architecture of global trade is already being permanently rewired. The world's economic map did not just fracture, it chose a completely different path forward.